I'm going to talk to you about paper 2 for AQA accounting, which is being held on Thursday the 16th of June. So this is based on the advance information that's been given to us by the exam board for the 2022 exams. So if you're watching this at a later date, it's not going to necessarily relate to your exams. Again, the caveat that this only includes advanced information for sections B and C. You'll need to check out the full specification. I'll give you some links at the end for anything that could come up on section A. So without further ado, let's have a look at section B then. So that will comprise, again, the two 20-mark questions. 14 marks for each will come from computational work and 6 marks from written stuff. And the advanced information topics for that are marginal costing and standard costing and variance analysis, which seems very straightforward until you look at what's actually involved. So marginal costing, quite wide-ranging. You need to be able to categorise costs. So direct costs, those that are directly involved with the manufacture of a product. Indirect costs are not directly attributed to manufacturing. Variable costs, so those that rise directly in line with output. Semi-variable costs, so those that contain an element of fixed and variable cost about them. Fixed costs, so those that don't rise in line with output. But remember, a fixed cost is not fixed under all circumstances. Other factors will cause it to rise, not levels of production, apart from obviously a stepped fixed cost, which does rise very straight line at a particular level of output. So understanding the difference between those. Marginal cost is the direct cost, all the variable costs added together. Okay, so terms, you need to be able to explain and calculate contribution per unit and also total contribution. So a reminder that contribution per unit is the selling price minus the variable or the marginal costs. And then the total contribution is the volume of output, so the number you're going to manufacture times by the contribution per unit. Okay, so we could be asked to do something to do with break even. So calculating and interpreting the break even point. So fixed cost divided by the contribution per unit, and obviously being aware that any change in the pricing structure of the product, which will change contribution, will have an impact on the break even point. As will any increase or decrease in the fixed costs of the business. Interpreting break-even charts. So what do they show? Identifying lines or areas on a break-even chart could be in the exam. The uses and limitations of break-even analysis methods. So the calculations and the graphs. So remembering all the pitfalls of break-even. It's a little bit simplistic. It assumes that everything behaves in straight lines. Everything's perfectly linear, which of course we know is not the case. The further on in production we go, usually the greater the economies of scale in terms of labour and raw materials. We should be able to obtain better discounts on our raw materials, and our workforce should become more efficient as production goes on, up until a certain point when perhaps they're working lots of overtime and their efficiency levels may well drop. So other limitations, it assumes that everything that is made is sold. It can only cope with one set of variables at a time. So if you want to change anything about the structure or the costs, then you need to recalculate everything. And it can only deal with one product. It can't deal with a mix of products. But obviously it's got a number of advantages. It's very simple to understand. Non-accountants love it. Bank managers love it. You can put it in a graph so it looks pretty, all those kind of things. We might have to use marginal costing to make decisions. So taking those marginal costing techniques, the results of break-even analysis, target profit calculations, that kind of thing, to make decisions such as whether we should continue to make something or buy it in, whether we should accept additional work. So often we just look at the contribution that would be achieved by taking on extra work. Price setting, so using perhaps Costplus pricing to use the to find the selling price. Remember that if we use marginal costing as a basis for price setting, we're going to have to add a very large markup to it because we still need to take the fixed costs, the overheads, into account. How we can make the best use of scarce resources, so limiting factors. So this is where something's in short supply. That could be the amount of material that's available, or the number of machine hours, or the number of labour hours. So how we can best use those to achieve the most profit. So that's generally going to be about finding the contribution per unit for usually a range of products. and then working out the contribution per hour or per kilo or whatever it is that's in short supply, ranking the products 1, 2, 3, 4, however many you've got, and then making as many of the first one as you can, and then so on, using up all the resources. So that will obviously make you the most amount of profit, but it won't necessarily give your customers the best choice. So just be aware of that. Closing a loss-making line or department, again, something to be careful about if we use marginal costing to make those decisions. We're not taking overheads into account. So if we close a loss-making line or department, how have the overheads been shared out? Is it really making a loss? And remembering that if you do close that department, you're going to be losing all of that contribution, which is contributing towards the overheads of the business, the fixed costs. Other issues with closing a loss-making line or department, what else are you going to do with the space? Are your products dependent upon one another, and so on? Target profit. So remember, that's the same as the break-even calculation, but you need to add your target profit to the fixed costs before you divide it by contribution, and that will tell you how many units you need to make and sell to achieve a target level of profit. So that was all the marginal costing stuff. Standard costing and variance analysis then. So we need to know the purpose and the advantages and disadvantages of a standard costing system. So this is where we come up with the cost per unit in terms of labour, raw materials, and overheads in real life, although we're not asked to calculate any variances for overheads. We save those for AAT level 4 and beyond. So yeah, advantages and disadvantages. Doesn't encourage continuous improvement, but it does enable you to calculate variances and break those down into different areas. So terms, what does standard costing mean? What does variance analysis mean? So standard cost is the forecast cost producing units of output. Variance analysis is where we take over or under spends and try and break them down further into efficiency, usage, price, rate variances, and so on. So the variances you need to calculate, and a reminder of the formulas there, the materials price and the materials usage variance. Be careful when it comes to standard quantities on materials usage variance. It needs to be the standard quantity for the number of units you are actually making, not the number of units you plan to make. So if they give you the standard quantity, say for 12,000 units, but you only made 10,000, remember you need to flex that standard quantity downwards. You'll need to do the same for labour when you deal with the efficiency variance. So standard hours isn't the standard number of hours for planned production, it's the standard hours for the number of units you actually produced. Sales volume variance, that's the only one that you're ever going to need budgeted output for. So the standard quantity when you're doing the sales volume variance is the budgeted or planned level of output. Compare that with the actual output, multiply it by the standard price, and then the price variance, just the difference in the standard price and the actual price times the actual quantity sold. So just a reminder there, standard quantity for materials and labour must be fixed. So standard hours for labour, standard quantity for materials. Your budgeted output is only used for the sales volume variance. You need to understand the interrelationship between variances. So something like a favourable materials price variance might mean that you bought poor quality materials. That could have a knock-on effect with the labour, because remember, when you're making products, if you waste them, if they go into the skip at the end because they're faulty, that might be down to the materials being of a poor quality, but that's also going to cause you to waste time. So you've got some labour costs also going into the bin along with the raw materials. So an adverse labour efficiency variance may not be the fault of the employees, it may be the fault of the raw materials. So it could be that they caused problems with the machinery. It could be a completely unrelated issue that's caused materials usage and efficiency variances. It might be that someone in the organisation has made a decision to cancel a maintenance contract on some machinery, which has led to breakdowns and wasted output. So that could cause, adverse variances across the board. So make sure that you can explain and identify any interrelationships, any clues given in the question. You're going to need to be able to reconcile budgeted and actual figures. So remember that if you want to reconcile the budget and the actual cost, I don't know what I was going to put in brackets there. So remember to start with the budgeted cost, and then an adverse variance will actually increase that budgeted cost and a favourable variance will reduce it. If you're asked to reconcile the budgeted and the actual profit, start with the budgeted profit, and then add a favourable variance, deduct an adverse variance, because a favourable variance will increase profit, and adverse variance will reduce it. Section C, we've got two 25-mark essay questions, and we've only been given two topics, so I would assume that one will be on absorption and activity-based costing, and one will be on capital investment appraisal. So remember, absorption costing is where we attempt to share out the overheads across units of output in a slightly fairer way. I mean, sometimes we might do it based on units of output if all our products are identical, but often we try and find a smarter way of doing it using machine hours or labour hours, depending on whether the process is labour intensive or capital intensive. It uses a lot of machinery. So we'll be using absorption cost to calculate the total cost of a product. So you need to understand the following terms. So allocation is where we allocate overheads to a department. So we might have three departments and a supervisor who only works in one department. So we would allocate their salary straight into the overheads for that department. Apportionment just means sharing. So it's where we share the overheads out on the fairest basis. So we might share something like rent out based on floor area, or canteen costs based on the number of staff that work in each department. Absorption is where we use an overhead absorption rate. So we look at the overheads that have been allocated and apportioned to each department, and then usually divide it either by machine hours or by labour hours, as I mentioned before, to come up with an overhead absorption rate. Under absorption is where we haven't absorbed enough. So usually our output might be lower than we planned, in which case we'll end up with an under absorption of overheads, and that needs to be added back as a cost in the income statement. It will reduce profit because we haven't absorbed enough overhead into cost of sales. Over absorption, though, could occur when we make more units than we planned, so our cost of sales is higher as a result. So that will be credited into the income statement and will actually increase profit. So you need to be able to do calculations to allocate and apportion costs. You need to calculate those overhead absorption rates and be able to apply them to units of output. I'm not going to go over any of that in any detail. I will try and record some separate videos on those topics. Activity-based costing is a development of absorption costing. So it's just like absorption costing, we're trying to share the overheads out, but it attempts to do it more fairly and takes things like batch sizes into account. So you need to be able to use activity-based costing to calculate total cost of a product. Understand the relevant terminology. So a cost pool is like a cost center. It's an area of the business to which costs can be allocated. So rather than just have maybe two or three departments like you would with absorption costing, with cost pools, you can end up with a whole load more of them. So things like ordering raw materials might be a cost pool, machine setups could be another cost pool, quality control inspections, and so on. So you can have cost pools that occur throughout the manufacturing process. So the cost driver, that's the activity that takes place within the cost pool that causes the costs. So in quality inspections, it is doing the quality control inspections. That's the cost driver. So attribution, that's how costs are attributed first to activities and then to units of output. We need to be able to do calculations to allocate direct costs, just like we did with absorption costing, and then use those cost pools to assemble all the costs for a particular area, and then work out what the cost driver is, and use that to attribute the indirect costs to particular products. So that's where you work out maybe how many batches or how many quality control inspections are done, and for each quality control inspection or each batch that a machine is set up for, you are attributing some overheads for that. And then you can throw all that in together and use that figure, direct cost plus the indirect costs that you've attributed, to calculate a selling price, so cost plus pricing. You need to know the benefits and limitations of absorption, activity-based and marginal costing, so be able to compare and contrast them. It could include the comparison of inventory valuations and profit calculations under different methods. So remember that if you are valuing your inventory using absorption costing or activity-based costing, it will include overheads. Remember, the higher the closing inventory value, the higher your profit, whereas marginal costing doesn't take that into account. Marginal costing isn't suitable as a basis for valuing inventory at the year end. It's not allowable under IAS 2. So watch out for that, but it is perfectly acceptable for management accounting purposes. Okay, so the final topic then, the second question potentially in section C, is on capital investment appraisal. So this could be a big project. We've got some pictures of some robots here to fully automate an area of the factory or the whole factory, to use robotics instead of people. It could be to build something, it could be to introduce a new system, it could be anything. So capital investment appraisal is where a large sum of money is going to be spent. And we've seen a question recently where a company is going to start making electric cars, investing 15 million. I have recorded a separate video on that, so you can have a look at how that's worked out. But first of all, the starting point is going to be to calculate cash flows that are going to rise from the investment. Sometimes they'll be given to you, other times you will need to calculate those. So just beware of things like depreciation. That doesn't belong in a cash flow forecast, so don't stick that in there. Calculating payback and net present value, the discounted cash flow of a project. So remember, payback is just calculated from the raw cash flows, whereas the net present value is where we take the initial outlay and then we discount all the future cash flows, add everything up together and see whether it offers a positive value. If it does, we should probably go ahead with the project. It will add value to our business, provided, of course, that the calculations are accurate. Understand the relevant terminology. So what payback period means is the amount of time it's going to take to repay the initial investment. It's a simple calculation, easy to understand, but it doesn't take into account the time value of money, inflation, cost of borrowing, all those kind of things. Net present value does address that issue. Net present value is often calculated over a long period of time. So the recent question, it was a 10-year project, the one on electric cars. And obviously, the further ahead you go in time, the harder it is to try and guess what the cash flows might be in the future. Discount factor, so what that is, that's we use a rate, so it might be 8% per annum, 12% per annum, to discount the future cash flows to bring them, all into line with today's prices. So we're stripping out the effects of inflation, cost of borrowing, all that kind of thing. Cost of capital, so what that is, so the cost of capital could be the cost of borrowing the money to invest, or it could be the opportunity cost. If you're taking the money from another project or off of a deposit, then it's whatever the opportunity cost is of doing that. So as I said, you need to be able to calculate the payback period, the net present value, and explain them. Weigh up whether a project is worthwhile or not is the most likely type of question here. So you need to understand the benefits and limitations of payback and net present value methods. So as I said, payback is very simple. Net present value is slightly more involved, but should be slightly more accurate, more meaningful. But as with anything to do with paper 2, it's all based on projections and guesstimates. So we've always got that fallback that the figures may not be completely accurate. You've got to be able to use capital investment appraisal measures in the evaluation of projects. So think about the financial factors. So, the cost, where's the money going to come from? Are you going to issue shares? Are you going to borrow the money? If you're issuing shares, it's permanent capital, doesn't need repaying, but obviously the shareholders will expect dividends. Whereas if we borrow the money, whereas dividends are optional, we don't have to pay them. We have to pay the interest on any loans, otherwise assets will be repossessed and the business could fail. So thinking about the financial factors, thinking about the non-financial factors. So the impacts on the workforce of changes, that's quite an important one. Will you need extra staff? Will you be making staff redundant? What's going to be the impact on the local economy? And all those kind of things. So all that sort of social accounting stuff can be brought in there. Brand reputation as well. Usually manage to wedge that in somewhere. So hopefully that's given you an idea of the types of questions that might arise in paper 2. And as I said, I shall record some videos with some more specific examples. And in the meantime, here are the links to the full specification, so you can check out everything that could possibly be included in section A. Past papers, so you've got the assessment resources there, and the advanced information, just so that you can check what I said is correct if you wish to. Thanks for watching.